Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. Happy Sunday out there to all my listeners. Happy Sunday out there to all my viewers. Happy Sunday to you, Mr. Tony Shore, and happy Sunday to a very special guest in the studio today, coming from the headquarters of Gradient Investments over in Minneapolis, Minnesota. Happy Sunday to you, Senior Portfolio Manager, Mr. Keith Gangl.
Thank you. Thanks for having me on again.
Yeah, thanks for being here. It's always a pleasure. I'm sure all my listeners and viewers, you're like, oh, yeah, cool. It's Keith. Or when we used to have Jeremy on the show, or then we'd have Tyler on the show. We've even had Mike Binger on the show. So it is always a true honor and a true pleasure whenever, Tony, you can score us a big hit like that from Gradient Investments. And we'd love to have them on every week. But obviously, I don't know how much you guys, I don't know how many shows you're on. I mean, think about all the radio shows, all the podcasts, all the TV shows, all the special guest appearances you guys do. You are obviously extremely, extremely high sought after professionals in the financial world. Because I mean, you've been on MSNBC, CBS, Fox News, you name it, you've been out there. And so we greatly appreciate you taking time out of your busy schedule to sit down with Tony and I this morning. And what we want to talk about today, I mean, I know we got to get caught up on what's been going on in our lives personally and just kind of how's everything been going. But just to let our listeners and viewers know, once we really get cruising into today's show, here we are recording. It's June 9th as of the recording of the show. This show will air about June, well, whatever this Sunday is. So it's mid-year. And so we're going to really talk about from Keith Gangl, who is a senior portfolio manager with Gradient Investments, who is a fiduciary manager on the Charles Schwab platform for us. And then we're going to talk about what happened in the first part of the year. Where have we been? The goods, the bads, and everything in between. And then from a portfolio manager standpoint, what I call in the trenches, what do they see the next 6 months looking like? So really a mid-year update and then maybe a second half of the year kind of outlook or forecast. But before we jump right into that, how have you guys been? Keith, what's been going on? I know it's been probably a month or two since you've been on the show. What's been going on in the personal life? How's everything going?
Oh, it's been crazy. So my son just graduated from high school, our youngest, last week.
Okay.
So that was kind of crazy. And then on top of that, his team went to state for tennis again for the third year in a row. So that was busy last week, state tennis tournament, high school graduation, grad party on last Saturday. So we're a little wore out. And then tonight we have the tennis banquet to kick everything off. And then high school is pretty much done. A little bit of a tear in my eyes. It's a little sad because my two girls are already in college, and then the youngest one will be going off to college as well.
Yeah, that's crazy, man. I mean, you and I, we've always talked whenever we get together at any of the lead advisor conferences about how similar our lives are, because you have two older girls and a son. I have two older daughters and a boy. Yeah. Your youngest just graduated high school. My oldest, Lexi, just graduated. So last week was her graduation.
Same thing,
She's very athletic as well. Like they went to states this year for cheerleading, for competitive cheer. She did really good in track. But isn't it amazing? Like you said, teary-eyed, man. I mean, you get so emotional about the last, right? Your last track meet, your last band concert, your last cheer competition, the last time I'll see her drive into that parking lot of the high school, the last time she'll be it's kind of crazy and it's exciting, but it's very emotional. And then Lexi's going off to Michigan State in the fall. So now we're getting ready for all these firsts, right? Oh my gosh, like my baby girl's going to be moving out of the house and into college. And so it's, I know exactly what you're going through.
Yeah.
You got a little bit of time on me though, because you've already experienced this with two of your children.
Yeah. That first one's hard when you send them to college.
Hard,
so that was a real tearjerker. It's like, your baby going off to college.
Absolutely. Yep.
That's tough on both
ends. Been very emotional in our household. I don't know if there's a day goes by where Lexi or mom or me aren't shedding, or maybe all three of us together shedding a few tears when we just see pictures and think about, where she's been and in her awesome life and where she's going to go. I mean, she's only 18 years old and it's like, man, it's tough though for a mom and dad. And I'm sure a lot of our listeners and viewers you're shaking your heads just like myself and Tony and Keith. Like, yep. Been there, done that. And a lot of you are even thinking about, grandkids graduating high school or grandkids off into college. So it's amazing, how fast the hands on the clock can only go so fast, right? But boy, I tell you what, it sure does seem like, especially once we had kids, that time flies. And now that they're graduating and moving on, the time goes even faster. I don't know where it goes or how it goes so darn fast, but it does.
Yeah, I'd like to slow it down, but it just doesn't happen.
No, it doesn't. Like to slow down the hands of time if we only could, right?
Yeah.
If we only could. Well, Tony, what's been up with you lately?
Oh man, I've been working outside, doing some landscaping work and just trying to get the yard in shape. And my wife wants a garden. She's got a to-do list for me, a honey-do list that's as long as it's longer than this hour-long show. I'll tell you that.
That's a long one. Then that's a
just
long.
to
Just
read
to read
the,
it. Just to read
yeah,
it takes. You didn't even start any
get through
project
the
yet.
list. Yeah, yeah. I'm gonna be busy for the next 90 to 100 years on the honey-do list. So there's that.
Keeping you young, keep you active, keep you young. Yep.
It gets me outside. It gets me doing things, and that's actually helped. I find I'm finally getting into the hand. I've never been a handyman. I don't like, things like that, but I actually had to buy a table saw. I bought a table saw.
Whoa!
So,
watch your fingers. Watch your fingers, Tony.
Well, really, it's more like it's a little table, and it's more like a miter saw. You just bring it down, and
chop saw. Yep.
It's yeah, it really works well though. Slick, a lot better than hand sawing.
Oh yeah, for sure. Yep.
So yeah, that helped the projects I'm working on. You wouldn't believe it if I told. I'm working on a Catio now.
Catio. So tell me more about a Catio.
Yeah, it's so my wife's got me. We have an upper deck that walks out. We have 2-level house. The upper deck kind of goes out, and then or a split level, and then down below we have a walkout basement. And next to it's a window and some rocks and stuff. Well, underneath the deck, the upper deck, she wants me to put against the window and put a thing going out and build a big screened-in room, screened-in patio for our cats. We have 3 cats. We'll probably have 4.
Hence the Catio. Okay.
Catio. Yeah.
You had like a Cadillac you were putting on your back.
That's what I was thinking, Jason.
Catio.
Or a patio for your golf caddies. No, this is actually for cats. And so I looked.
Okay.
You can buy them, but I'm just gonna make it. It's wood.
So the cats would be able to walk out of a window from the house and out into a screened-in, their own screened-in patio area outside.
Yeah, exactly. And so we've got a dog and 3 cats.
I can't wait to see pictures. Especially with you working on it.
Oh, yeah.
I want to see what it was supposed to look like, and I want to see what your version ended up looking like.
Yeah,
I will.
Building inspector will be over shortly.
Oh, those poor cats. Those poor cats.
I think we'll get away from the building inspector on this one. It's just, I'll say it's movable. It's not permanent. Okay. We won't permanently attach it to the house probably, but yeah, it's crazy. So that's what I've been working on. Keith, I know summer, you've probably been on the boat, on the golf course. What are you doing?
Got a little boat. Like I said, I've been doing a honey-do list too for the grad party. It seems like I thought the Queen of England was coming over to our house, so the list of stuff I had to do. So
it's crazy, isn't it? Oh yeah.
It's just like we've been in our house for 25 years, so I mean, obviously, it's pretty well kept up. But I thought the list was like I thought we'd have to start out from scratch. It's crazy. So, but anyway, we got through it, and a lot of people came, had a good time, so it turned out great.
That's great
right now. Because we're having our grad parties in 2 weeks, and so we're in that. You know what it is? That 2 weeks before seems like the list keeps getting bigger. Seems like the stuff I'm getting done doesn't come off the list. We're never going to have enough time to get it all done.
Yep.
But at the end of the day, my wife and I were talking this weekend, just saying, you know what? It is what it is. We're going to have the best party we can for our daughter, whether we get that little piece in the yard done or that little trim fixed. It is what it is. Let's just do the best we can, and hopefully, it's the thing we really hope for is good weather. But again, that's nothing you can. I can put the piece of trim up. I can mow the yard. I can't control the weather. So I'm like, well, pick your battles, right?
Yep. You got it. I went through 3 of them, 3 high school grad parties. So I did all 3. I thought all 3 came out very successfully, but was there stress leading up and panic? You know what we did though? We saw all our friends and our neighbors all had kids similar. And we had been to a couple other we'd been to many other graduation parties and where they host them at their house. And we're like, there's this great facility that we can rent that's really cool. We live in a cool town, downtown Stillwater. It's the oldest town in Minnesota. It was the first established town anyway. It's the birthplace of Minnesota on the river. So we went downtown, nice brick place with a park and open and a patio, and you can rent it. So we had our parties there.
So you had all 3 of them there. You didn't have them at the house?
Nope. Not one at the house, and we are so excited.
Now, and Keith, he's never done a party at the house, but now he's trying to build a Catio.
Yeah,
we got to see these after pictures.
Jason.
Hey, see if your wife will videotape. Will your wife videotape you like through the steps of building this thing?
She will be taking pictures and posting them, I'm sure, to humiliate me. Yeah,
can't wait to see those.
It's part of the bargain. Okay, let's jump into the markets. That's why people are tuning in. But first, we're going to give away a few copies of your book, Empower Your Retirement, Jason. So, listeners, get a copy of Jason's book. It's a great book, Empower Your Retirement. Hope for the best, but plan for the worst. Make sure you have a plan in place. All you have to do is be one of the next 10 people to request a copy. Call in, talk to Jason's staff there at Great Lakes. Tell them you heard about it on the show. 989-835-7203. That's 989-835-7203 to get your own copy. There's no cost. There's no obligation. We'll send it to you at no charge, no postage. Just call in and request a copy. All right, and we're going to be right back with more of your Financial Empower Hour right after this. Welcome back to your Financial Empower Hour. I'm your co-host, Tony Shore, and I'm here with our host, the man with the plan, is Jason Cryderman. As always, our host extraordinaire and a great financial planner and giving great advice for our listeners out there. But today we have a very special guest, senior portfolio manager Keith Gangl from Gradient Investments. Took time out of his busy schedule, appearances on major networks and all over the place and managing portfolios to be on the podcast today. Jason, huge get, right?
Yeah, it's always good. It's always awesome when we can have Keith or another member of his team from Gradient Investments. Not only are they very highly sought after, and they're on every major network you can think of. They're on a bunch of different radio shows. They're on different podcasts. They're very highly sought after for their professional expertise in managing money. And not only do they manage a lot of money, but they're very highly sought after for the reputation, how well they manage money, and their philosophy. And so a lot of times when I get a chance to speak with Keith or another member of his team, I love to pick their brains. Like, okay, what's going on right now? And when we heard this on the news, what did you guys think? And what did it really mean? Because there's a lot of noise out there, right? There's a lot of rhetoric. There's a lot of noise. So I like to really just get it dumbed down from in the trenches. Like when all we hear this stuff on the news and Facebook, what does that really mean to stock markets? And Keith and your team, what are you guys doing about it? Because all that rhetoric and noise, if it really doesn't mean anything to managing the money, but it just gets everybody all emotional and upset, that's when investors tend to make the wrong financial decisions, when they just don't really know or understand the true impact of whatever you heard, whether it's the T word of tariffs or whether it was recession or it was COVID or whatever it is. We hear these bad things and we freak out and panic, but until you have a chance to understand it from somebody who that's their job, that's what they do in the trenches day in and day out, like Keith Gangl or another member of his team, it really helps me help my clients and ease their emotions and manage the money to the best of their interest, not just because of what you heard on Facebook or saw on TV or the radio. So, Keith, that's what we want to start talking about today. Thank you again for being our guest. What we're going to go through, I'd like you to help us with, is here we are beginning of June. So let's talk about January 1st till June, first week of June. Like what all did we go through? We had an election, we had inauguration, so we've been through January through June. Let's take the first half of the show and talk about that. Where are we today? Where have the markets been? Why have the markets done some of what they've done between January 1st and now?
Yeah, you summed it up well, saying a lot of noise out there, a lot of emotions. And you said it well. Stick to your plan. As professionals, I've been doing this for almost 30 years. We kind of try to dial out that noise.
That's the senior part, Tony.
Yeah. Well, that's part of the senior part. The senior refers to a lot here, I think.
Yeah, senior. Yeah. No hair. That's from the stress for me watching the market, so you guys don't have to do it. So, but it's crazy the noise this year in the media, what they're talking about. You said Facebook, doesn't matter where you're at. There's so much noise. And it's funny, I go around, I know what the markets are doing on a day-to-day basis, but it feels a lot worse than it actually is. And I go ask people when I see them, it's like, they know I'm in the business and they say, oh, these markets are terrible, this and that, blah, blah, blah. And I'm like, all right, what do you think the markets are up or down this year? Most of them, hands down, say the market's down and is down
Correct.
pretty aggressively, which when you take a step
That's what they
back,
think, right? That's what they think because that's what they're hearing or seeing.
That's what they're exactly, and that's what kind of
That's
what they feel just because that's what they're hearing on the news. But when you look at the facts, the market, the S&P 500 year to date, like you said, through the first week of June here, market's up over 2%. That's, again, the way you feel, it feels like it's down 10, 15, 20%. And I had another call with another advisor and clients, and they're saying, oh, my plan is terrible, this and that. And it's like, at the end of the day, their plan was actually slightly positive. They had that feeling, that noise out there is overwhelming. So that's why me as a portfolio manager, I got to take that noise and kind of look at the facts, look at the company fundamentals. How are things doing? How's GDP growth rate? Earnings, Q1 earnings just got over and they were really good. And then you mentioned the T word. I think we'll save that for the second half. The tariffs, we'll talk about. That's contributing to a lot of the noise.
Sure,
right?
Yeah.
So at one point in time, again, if we back up just 6 weeks ago, the markets were up about 4 or 5% to start the year. Then the T word, Liberation Day, came out, and I think it liberated everybody from their pocketbooks because the markets sold off pretty aggressively. The markets were down about almost 20% from peak to trough there, but we've rallied over 20%, and now we're up 2%. So the one thing, you do a great job in the show and your clients is you tell them to stick to your plan. There's a lot of volatility. Corrections are normal. It's the other thing I like to point out. We do have corrections. I mean, I've been dating myself 30 years. And it'd be nice if, the S&P over long periods of time, averages between 8 and 10, depends on the years you're looking at. Sure. So let's say 9%. It would be lovely if we could come in and say January 1st to end of the year, we're going to be up about 75 basis points a month. It doesn't work that way. There's volatility. There'll be correction opportunities. And that's typically the time you actually want to be stepping in if you were, had some cash on the sidelines, or maybe you were, a little more defensive. That's the time you actually want to add. And then when the markets have some really good years, like we've had the last couple of years, we talk about this year, coming into the year about bringing an umbrella because we were worried that the markets would be choppy this year. We were forecasting, again, my crystal ball, probably as good as anybody else's. Again, it's a crystal ball. We were calling for that normalized year, which is at 8 to 10%. At one point in time, we were up a couple, down 15. Now we're up a couple. I still stick to that forecast. I think by the back half of the year, we kind of still finish that normalized year, but it's not a straight line, right? Because we just talked about we were up, down 15,
That's right,
up 20. So it's like, that's why you need to stick to your plan. And you do a great job with your clients. The other thing we talk about is diversification, right? We want to have, diversified holdings. We don't all in one portfolio. You're mixing in some of the buffer products. After the 2-year run, when I'm talking about the market was up, the stock market, S&P 500, most of your clients aren't all in the stock market either, right? They have other things as well.
I mean, obviously how we manage money, hardly any of my clients, I manage money for 100% in any one sector of the market, like the S&P 500. Yep. We have some exposure, but you mentioned the D word, very well diversified. Tony talks about my book. We give away copies. The title of my book, or the subline of my book, is Plan for the Best, but Prepare for the Worst. Well, we plan to have a great year every year, right? But we're also prepared. So when we manage portfolios, I build them and design them and diversify them to be prepared for what happened when Liberation Day, right? When the market fell 18, 20%. None of my families were down that much at all because of how I build the portfolios and because of how you guys and your team manage them. So, take that in consideration, as Keith said. Stick to your plan. Have a plan. And the plan shouldn't only be, well, I'm all in. When the market goes, I'm going to make a lot of money. Well, what about the bad days? Oh, God, I don't like looking at my stock market. I won't open my statements. No. Plan for the best, but prepare for the worst. Build a plan that says if these things go good, I'm going to be prepared and I'm going to take part in that. But if things don't go so good, because they're not always going to, it's not a straight line up. No. Bring the umbrella. Be prepared for rain. Be prepared for those bad days, bad weeks, bad months. We're going to have them. And if as long as the portfolio is designed to be prepared for those and you're diversified, you're going to come out just fine. And that's where most of my families are finding themselves today. And even a month or two ago when everyone thought the world was coming to an end. And no, my phone didn't ring a lot from panicking clients because they knew they were prepared for that and they were going to be okay. They were sticking to their plan.
Yeah, you do a great job of having them stick to the plan because we were getting a few calls, very few, just generally speaking. Some of the newer advisors kind of like, oh my goodness, the markets are down 15, 18%, like you mentioned. I got to get my clients out of these stock portfolios and get them into either bonds or some other safety. I'm like, well, that's the wrong time. And when you built these plans, you're diversified like you do. And then you're also we're not looking at just 1 year, you're looking at 3, 5, 10 years.
Correct.
How do you build a sustainable plan? And these are the opportunities to actually put money into the market. Absolutely do not panic. That is the worst investment anybody can give you. That this all in, all out. If I could time this, you and I would be on an island somewhere, Jason. Completely retired. Markets are hard. It's not. You can't time them. Again, even with all the experience I have, it's you got to stick to that plan. Like I said, when things get a little expensive and had a nice rally, you kind of peel some of that off and diversify. And then when markets are kind of have that opportunity for you to be buying in, that's when you want to do it.
Yeah, and like you mentioned, opportunity. So a lot of people, it's the noise, right? We hear all the noise, we hear all the fear and the panic, and the world's coming to an end. And so we knee-jerk react, and we make unfortunate decisions financially from our emotions. And that's the emotional investing side that it's very tough to do. You mentioned, Keith, when we have some gains, pull some chips off the table, pull some of the winnings off. And how we were all taught to invest our money, whether it was grandma and grandpa, mom, dad, aunt and uncle, whoever it was that told you when you started investing your very first dollar, they told you the 2 rules of investing: buy low, sell high. Buy low, sell high. That's how we make money, right? Well, think about what they told you to do. They told you to sell off your winners, as you said, Keith. When something's up 20, 30, 40%, maybe I should sell some of that off. That's hard to emotionally do, is say, wait a minute, that thing's up. Why would I sell that? That's the one I want more of. And then when things are down, buy low means buy something that's down and not doing so well. And that's hard to do as well, because now we think, wait a minute, I'm going to sell my winners and I'm going to buy losers. And at the end of the day, that's really how to invest and make money, is take the emotions out of it. Now, you don't just go out there and buy something that's a loser. You need to have, like yourself and your team at Grady Investments, who's in the trenches and they're studying this stuff every day. They're looking at crisis creates opportunity, right? Crisis or market pullbacks. Anytime there's a pullback or a crisis, there's opportunity. Find one that's not doing so well, whether it be a company, a fund, a sector, whatever that might be. They're not doing well, but their earnings still look good. Their forecast still looks good. They still got a good potential. That's not a loser. That's something that's going through a pullback or a crisis, which creates opportunity. Those are the ones we want to invest in. Again, plan for the best, that they're always going to go up, but they're not. So prepare for the worst. Prepare to be positioned for diversification and reallocation.
Yeah, I think that's huge. Now, we need to take another moment to let our listeners know, before we go on, how they can get a hold of you. If they have questions, or even have questions for Keith, they can contact Jason. And Jason, you can get in touch with Keith about managing their portfolio or how to get a plan in place. I know you do investment plans, retirement income plans. This is really important stuff. So listeners, if you want to do that, all you have to do is pick up the phone and give Jason and his team a call at 989-835-7203. That's 989-835-7203. And make sure you let them know you heard about it on the show. And you're listening to your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with our host, Jason Cryderman, and our very special guest today is Senior Portfolio Manager Keith Gangl from Grady Investments. Great discussion so far, guys, talking about where we've been this year. What's next?
Yeah, I think it's been great so far. Let's Keith, let's dig into, we started talking really about the S&P and that it was up 4 or 5%, and then some rhetoric, some talk, some scare. Market went down, but now it's back up. We had one heck of a rally in the last 4 to 6 weeks. We're back in the positive territory. Before we get into what maybe the analysts are saying or the markets or businesses are telling us for the second half of the year, let's talk about other sectors, because we talked about diversification, right? Diversification is huge. We can't just focus on the S&P 500, because there shouldn't be anybody out there that has 100% of their money invested in just the S&P or any one sector. Mm-hmm. So let's take us through maybe like the top 4 or 5 sectors this year and how, where we are from January up until now, from international markets, from bonds, from precious metals, and then throw out some interesting ones. Maybe we talk a little AI or Bitcoin or something that had some hype, maybe pulled back, but still has some opportunity. So where have we been from a diversification standpoint so far this year with other sectors?
Yeah, that's a great question. Obviously, the last couple of decades, the U.S. stocks have kind of led the world. One thing we're seeing this year, again, as much as we rebounded here, that 20% up a couple percent on the S&P 500, outside of the U.S. has had some phenomenal actually growth this year. I mean, international developed markets are up about 18% year to date. That's pretty impressive. But again, they've lagged for the last several decades. So it's something we're monitoring. It's like we have a little bit of allocation there, and we have to decide, okay, is this going to be real or is this something more temporary? So that's a big surprise this year. And to your point of, that's why we do diversify, because sometimes these areas that you don't think are going to perform very well, all of a sudden, boom, they start working. Another area is, like you just touched on, has been really good. And a little bit, it's the fear factor, worry about inflation, has been gold. Gold's almost up 28%. That's crazy. That's like a stock market move. So you'll go with periods where gold's been good for the last 3-4 years. Then you'll go for a decade where gold doesn't do anything at all. But when people are worried about, kind of, they hear all this news, you got the fear factors high, the gut reactions. Okay, It's hard to go buy the stocks, but maybe I want to buy this kind of flight to safety, kind of storage of value against inflation. That gold checks that. The other thing that's a little more speculative that's been around more recently, and you and I have talked about in the past, has been, the digital currency, or Bitcoin. I mean, that's up, 12% this year, and it's up another few percent again today. And if you go in the last couple of years, that was up over 100% in a couple of those years. So that's a very volatile sector. And again, you do a nice job too. Is just because that's a shiny object that's working well, all your clients, okay, I want something that's up 100% every year. It's like, there's a lot of risk usually when you see something move that quickly. But again, if you have, if you have a diversified plan, it's not a bad place if you have a little sliver of an overall allocation. Again, we want to keep that small. Anything that's moving that much is, probably generally want less than 5%, because that's a pretty volatile sector. And if you put all your eggs in one basket, again, you don't diversify, and all of a sudden, this kind of area it can be dropped 50% in a matter of
quick. Any of those sectors, right? I mean, and that's what I try to talk to all my clients about when I build them a financial management plan is, look, yes, we want exposure for opportunity, right? We want exposure to Bitcoin and to precious metals, of its gold and international. We want that exposure because we want to be diversified for that potential opportunity. But we got to be careful not to become greedy or overweighted and get hit by devastation, right? Opportunity is great. Devastation could destroy you financially. And so, you mentioned, like, I try to tell all my clients, and let me know if this is wrong, Keith. I try to tell them, like, maybe some sprinkle on top. You want some Bitcoin or something like that, sprinkle on top, maybe no more than 5 to 10%. Yeah. Even in international markets, maybe no more than 5 to 10% of the portfolio. Even in gold, precious metals, 5 to 10%. If we're spread out in all those opportunities, we're going to have the upside opportunity. We're planning for the best, but we're also not letting ourselves get 20, 30, 40% there just because we got emotional and scared. And now that sector does fall and we just lost 50%. And it's just, to me, not worth it for the long-term portfolio.
No, you nailed it right. You just got to size appropriately, and that's what you're doing with your clients. It's like, okay, these are a little more speculative areas. And yeah, you can, like I said, I like your analogies, sprinkle it on top, right? If you got a nice ice cream sundae, it's like, okay, the ice cream should be like the U.S. market, and then those little sprinkles and little whipped cream should be some of those other things as well to kind of diversify and provide some of that potential outside, participation when these markets are doing well. But be aware that, if things turn on them, some of these more speculative areas can be down 30, 40, 50% in a matter
real quick.
Yeah. So that's the deal there. So, but generally speaking, that's how we talk about diversifying and then within the portfolios that we manage as well, whether it's an all stock portfolio, we diversify as well. We're not going to own all technology names. We'll own some technology, we'll own some healthcare, we'll own some industrials. And generally speaking, when we look at the overall economy, that's kind of what earnings drive the overall stock market. They're very healthy, and the forecast for this year for about 9% earnings growth. Typically, for the last couple decades, it's between 6 and 8. So we're 9%. That's a tailwind.
That's pretty healthy.
That's a very healthy number. Unemployment, we just saw last week at 4.2%. So most people that want a job can find a job. Things are slowing a little bit, but generally speaking, no one can spend like the U.S. consumer, right, Tony? We love to spend. So
love to spend money.
When we're working, we're throwing parties, right, Jason? And those don't come cheap. We're building Catios and everything else.
Oh,
that's right. Think about it. I can't imagine what the cost of a Catio is nowadays.
Yeah.
Single-handedly,
that's why I'm doing it
economy,
myself to save money. That's why I'm doing it myself. You can buy them, but
well, you know what you mentioned right there, Keith, is very powerful, right? The consumer spends money. The American consumer spends money. At the end of the day, stock market is really driven from the consumer and from the company, the corporation, right? And with these tax cuts that we're seeing right now, if we keep these lower tax breaks for the consumer, for corporations, that's a positive for both the consumer and the corporations, right? So low unemployment, that means more people are working. When your money's not taxed as much, you have more money in your pocket. When you have more money in your pocket, you do what with it? You spend it, right? We spend it. When we spend it, it goes back into the economy, more taxation, more corporate benefits, corporations make more money. So really, I think both sides of the market from that standpoint, the consumer side, the spender, corporations making profits, both of those are very strong right now. Everything else going on, all the craziness, those are the two strongest, I think, anyhow, that are supporting this market.
Yeah, that's exactly right. You nailed it. And the one other thing I would add that no one's talking about in the media, they love to talk about tariffs and how bad and, creating this fear factor. Again, that's part of it to drive eyeballs to these news services. One thing that no one's talking about is the price of oil. That price of the pump's going down, and you're in Michigan and, us
fairly
in Minnesota.
Inexpensive.
Yeah, that price of oil goes into everything, whether it's you're driving to and from work, it's anything you're getting delivered by Amazon, it's whether you're going to Home Depot to get, materials for your Catio or whatever it is. It's when the price of oil comes down, that's a good thing for the consumer. And again, more money, just like you said, more money in your pocket. That's fantastic because they'll spend it, which drives corporate earnings, which again, then they can reinvest and employ more people and more products. And the circle keeps going that way.
Yep. Yeah. I mean, it's overall, like a lot of people say, gee, what's shape? Overall, I think we're in a pretty healthy economy, healthy market. And the numbers and statistics are saying that right now.
Yeah.
It's the noise. We got to calm down the noise.
Yeah, and I think that'll happen over time. So I think our earnings we're getting towards the end of them, and it's been good in the guidance going forward. So I mean, I think people are starting to take a deep breath, and I think that's why you've seen this market rally in the last 6 weeks.
Yeah, I mean, but also things could change. Things can change quickly, as we've seen. I mean, again, I always say somebody sneezes in China, the markets take a dive, or the president tweets out something someone doesn't like, and the markets take a dive, or they go way up based on it. But that's just really short-term fluctuations. You got to look at the long term, and like you said, Keith, the people that panicked earlier in the year may have they lost out, right? I mean, even when there is an actual major market event like 2008 or when COVID first hit, if you stayed the course, you not only did okay, you came out ahead, right? Because of the markets, and they just rebound really well. So we'll talk a little bit more about that here after this break. We do have to give away some more books. I love to give away Jason's book. I just want to make him buy more books. It's just something I do to kind of poke Jason. So we're going to give away 10 more copies of Jason's book, which is called Empower Your Retirement. And that's great. Plan for the best, but prepare for the worst, right? That's what you want to do. And Jason's written about that, about a lot of things: maximizing Social Security, IRAs, 401ks, rollovers, Medicare, Social Security. It's all in this book, and you can get a copy, no charge, no postage costs even. No obligation. Just be one of the next 10 callers into the office, 989-835-7203. And you have to tell them, I heard about it on the show. That's 989-835-7203. And we're back with your Financial Empower Hour. I'm your co-host, Tony Shore, and I'm here with our host, Jason Cryderman, and our very special guest, Keith Gangl from Gradient Investments, the senior portfolio manager there. Great show so far today, right, Jason?
It's been a great show. Yeah. I love getting kind of in the head, in the minds of somebody like Keith Gangl and his team, who really what they do on a day-to-day basis. They don't meet with clients like I do. They don't necessarily design financial plans. They're the ones in the trenches managing the money. They're the ones doing all the research.
Hang on, we lost the audio there for a second. Give me a test 1 2, Jason.
Test 1 2. Test 1 2.
You're back. Did you hear that, Keith?
Yeah, it dropped though for right after.
I pulled my head way back from the mic.
Yeah, well, no, it was there was something else too. Make sure, your mic's face forward. Just start. Pretend I'm Mitch. Will have to edit this out. I'll make a note of it. They'll edit the video. So where you're going to bring us in is where to next, or what's next.
Yep. Yeah, you're absolutely right. It's a great show. And I love whenever we have an opportunity to talk to somebody like Keith Gangl or another member of his team at Grady Investments, because I can build I can build financial plans. I can help people figure out what are your goals, your dreams, your objectives. How should we have this money diversified and build this income plan or this tax plan? But we need people in the trenches like Keith and his team. They do all the research. They are looking at every sector, every minute of every day the market's open. Where do we buy? Where do we want to be at? Where do we sell? Where do we want to get away from? What companies are showing better profits? So it makes an awesome team. And it's even better when I can have you guys on the show like this, Keith, is so they can actually see and hear the people in the trenches talk about real life, why they do what they do, why you do what you do with families' monies, and why you have such a phenomenal track record, and why you are so highly sought after from all these other advisors and all these other companies and all these other media outlets out there. So again, it's been a great show. I greatly appreciate your time and your experience and knowledge, Keith. So let's talk about now, as we kind of wrap up towards the end here, where do we think, what are all the gods telling us the second half of 2025 might look like?
Yeah, I think it's going to remain choppy. I think you guys, we touched on earlier. There's a lot of things still in the news. The T word, tariffs, right? That's still not resolved yet. I'm more in the camp, but I've been saying even when the market was going down, it's the art of the deal, or is Trump, creating economic chaos? I think he's the art of the deal. I think what we saw on April 2nd was kind of the worst case scenario of all these different tariffs. We've kind of slowly been walking our way back. We've made a deal with the UK. China went from 10% to 20 to 45 to 105 to 145 in a matter of weeks. And then all of a sudden Trump had some soft negotiation. Again, nothing's finalized there. We're down to about 30%. So I think that's more realistic. Sure. At 145%, tariff on China, that's basically an embargo. Anything that you're getting from China, you're really not going to get it unless it's a widget going into maybe a car that you need that piece, so you can't get somewhere else. You'll pay it, and then you try to pass it on to your consumer. But if it's like clothing and other items, I think consumers just will say, no more, I'm going to buy something else. So that's not good for China either. So that's why I think it's going to go to 30%. And I do think it's going to be, it's a fluid situation. Like Tony said, we can see any tweet anytime, and all of a sudden that 30% goes back to 60 or 90. So that's why you do a great job with your clients. It's like, take this noise out. This will all sell over time here. The other thing we got to keep an eye on is it is a fluid market, is this big, beautiful bill working its way through Congress, right? I mean, you got a lot of hands in the cookie jar on this one. So, and Jason, you're absolutely right. The one thing I do want to see for sure out of everything is to kind of keep the tax cuts that were from 2017 and 18 in place, because I think that's with lower taxes, both in the consumer and corporations. With the consumer, if they have money in their pockets, like we mentioned earlier, they'll spend. Now, we don't want to know if nothing happens, if no bill gets passed, those rates are going back up, and they're going up for everybody. I mean, from low end income to high end income, those will be going up. And I don't want to see that. I'd rather see them stay in place. I don't necessarily we need any more cuts than we have, but I think they're at a very comfortable level that people can make good decisions on it. You're not paying too much taxes. Again, everybody's got to pay some kind of taxes, but they're at a good level. Corporations, I think they're fine where they're at. We've lowered them. Now we're more competitive in the U.S. versus having these high 30+% on corporations. Now they can compete with the other countries in the world, and so I think that's a good thing. So we need to see that. And again, there'll be a lot of noise coming out of Congress and the president, and whether things are going to pass, who's adding whatever onto the bill. So that's kind of our next key focus. I do think it gets passed. It may not be everyone be happy, which generally speaking, everyone's not happy is probably a good thing. When there's, both sides kind of feel some pain, whether,
absolutely.
Some
it shouldn't be one side,
or,
right? It shouldn't always, one-sided. I mean,
no, it shouldn't be one-sided. And so I think that's the two big things. And then obviously we just finished, like I mentioned on top of the show, we finished Q1 earnings, and they were a lot better than expectations. One of the things that we were fearing as investors that the companies wouldn't give guidance due to this tariff uncertainty, but they did a great job at least giving general guidance of saying, things are generally well. They're slowing down a little bit, but that gave us as investors a little more confidence. And I think that's why we saw the markets rally. Now, every quarter we get a new set of earnings. So we fast forward here in, a month and a half, we'll look at Q2 earnings. Are companies following through? Are they executing? Was there a real, we're going to be a little bit farther into this new tariff since, April 2nd. We'll see, was there some kind of underlying impact that no one appreciated? And that's what you mentioned, that's what we do in the trenches. We're constantly reading things and, looking at companies, comparing them in their industry, listening to conference calls. Like I said, when I meet people, they ask what I do, I tell them, but then I also ask them, what are they doing? How is your business? Is it better or slower? Are you importing stuff? Or are you exporting stuff? That's the things that we have to consider. And even with these tariffs, the other thing to remember is, tariffs are basically a tax. Now, the media wants to tell you that tax is going all on the consumer. That's going to be partially true, but not all true. It's like the supplier could eat some of that cost, the person selling it could eat some of the cost, and the consumer, the one buying the product, could eat some of the cost. So I don't know. Every industry is going to be different. Depends on how demand your products are. Ideally, the companies want to pass on the consumer. The consumer at some point says, no more, I'm not buying any of this stuff. It's going to get pushed back to the company selling it and to the company actually providing that, whatever that widget is as well. So these are all things that we as investment professionals constantly reading things, kind of trying to look at surveys and studies and trying to make a prediction of where things will settle out. And again, this is every year. I've been doing this for almost 30 years. How many years do you think there's been no concerns in the overall market? 30
None.
years?
Zero.
None.
Zero.
This year, I would say it's probably a little more amped up, and that you are right. And it's part of it because social media is a little bit more influential than years in the past. And again, it's with the country kind of somewhat divided on policy side of things or political side of things. I think there's always one side throwing eggs at the other side, saying this is a bad policy or that's that doesn't happen, Tony.
Wait, Keith, we're divided? I don't
yeah,
yeah, that happens. Yeah.
But I do think the companies, themselves are executing, right? And they'll figure it out.
Yeah.
Even when once this tariff noise at some point in time is just going to kind of go to the backside. I think they could still be around for years, but the big shock and awe on April 2nd, I think that's over with. And now it's just more minor little waves if something pops up. I don't think it's going to be that massive, oh my goodness, what's happening? At the end of the day, I do think tariffs will be higher than they were on April 2nd, though. That 10% across the board could stay in place. But the other thing we haven't talked about either is the fact that now we're realizing how many other countries are putting tariffs on U.S. products that we export.
Mm-hmm.
That was never talked about before. So if nothing else, that's out in the discussion area, and we can decide how that impacts our companies that we're investing in as well.
Yeah, absolutely. No, I think that's great advice.
Yep. Well, we're out of time, guys. It flew by. Hate to bring this to an end. We could talk to you for a long time, Keith, and get your wisdom, and Jason, yours as well. Jason, before we go, we should probably give that information out one more time, correct?
Yeah, go ahead. Yep. Let them know. Go ahead and give away some more books. Why the heck not, Tony?
Yeah.
So
okay.
Just so you know,
I got my book already.
That's good. In the last 2 or 3 weeks, Tony, we've given away the most books. So I love it. Every time you do this, we give away 2, 3, or 4 more per week. And so it's awesome. It's wonderful because really the reason that my dad and I put this book together was not to become rich off selling these on Amazon. Because when you buy one of these books on Amazon, I'll get a check about 6 weeks later for 72 cents. That's my royalty. So I don't get rich off selling these things. Tony, I love the fact that you give them away on the radio show. We're sharing this wealth. We're sharing this knowledge, getting it out there to the public. So please, by all means, let's give away. Let's try to hit the record this week. Let's give away over 20 books.
Yeah, there you go. Wow. Okay, so to get your copy of the book, be one of the next 10 callers at 989-835-7203. And again, there's no charge, no obligation, no postage. We'll send you a book. All you have to do is mention you heard about it on Jason's radio show. Call 989-835-7203. And thank you, Jason, and Keith Gangl from Gradient Investments. Thanks for being on the show. That does it for today's episode of Your Financial Empower Hour.